Ever wondered how index funds work? Well, let's dive into this fascinating world. Index funds are a type of mutual fund or exchange-traded fund, also known as ETF, that have a simple aim: to mirror the performance of a particular market index. You've probably heard of some popular market indexes like the S&P 500, NASDAQ, or the Dow Jones Industrial Average. These are like the pulse of the market, and index funds strive to mimic their heartbeat. They are considered a passive investment strategy, which is a fancy way of saying that they don't involve hand-picking individual stocks. Instead, they hold a broad and diverse portfolio that reflects the chosen index. This approach, while seemingly straightforward, actually requires a deep understanding of market dynamics. And it has a bonus too. It often results in lower fees compared to funds where stocks are actively chosen and managed. So, index funds are all about mirroring the performance of a specific market index. But how exactly do they do that? Let's dive into the mechanics of index funds. These financial vehicles, whether they're mutual funds or exchange-traded funds, essentially aim to replicate the performance of a specific market index. Think of an index as a barometer for a section of the stock market. Some well-known examples include the S&P 500, which measures the performance of 500 large companies listed on the U.S. stock exchanges, or the NASDAQ Composite, which includes all the stocks listed on the NASDAQ stock exchange. So how does an index fund work? Well, instead of a fund manager making decisions about which individual stocks to buy or sell, an index fund simply aims to hold a diversified portfolio that mirrors its chosen index. This is a passive investment strategy, which means the fund isn't trying to beat the market, it's trying to match it. For instance, let's take an index fund that tracks the S&P 500. This fund will hold shares in the same 500 companies that make up the S&P 500 in the same proportion. Therefore, when the S&P 500 goes up, so should the index fund. And when the S&P 500 goes down, the index fund should follow suit. The goal here is not to outperform the market, but to mimic it. This approach has several benefits. First, it provides broad market exposure. Rather than putting all your eggs in one basket, so to speak, an index fund spreads the risk across a wide range of companies. This can help to smooth out the highs and lows of the market, making for a potentially less volatile investment. Second, because there isn't a fund manager actively buying and selling stocks, index funds often have lower fees than actively managed funds. This can make them a more cost-effective choice for investors, especially those who are just starting out or who prefer a more hands-off approach. So, by holding a diversified portfolio that mirrors a specific index funds provide broad market exposure. But what does this mean for the investor? Scene script. Index funds can be quite beneficial for investors. But how? Well, let's dive into the details. One of the primary advantages of investing in index funds is that they provide broad market exposure. This means that instead of putting all your eggs in one basket, or in this case, investing all your money in a single company's stock, you spread your investments across a wide range of companies. This diversification can help to spread and potentially reduce risk. If one company's stock takes a hit, the impact on your overall portfolio can be cushioned by the performance of other stocks in the index. In other words, you're not tied to the fate of a single entity. Moreover, index funds follow a passive investment strategy. This means they aren't trying to beat the market, but rather they aim to mirror the performance of a specific market index. This approach reduces the need for fund managers to constantly analyze market data and make investment decisions, which can be time-consuming and expensive. This leads us to another significant benefit of index funds: their cost-effectiveness. Because they don't require active management, they often have lower fees compared to actively managed funds. Lower fees mean you get to keep more of your investment returns. Over time, this difference in fees can add up to a significant amount, especially when you consider the power of compound interest. Lastly, index funds are typically straightforward to understand. You know exactly what you're investing in, a broad section of the market. There's less guesswork involved compared to trying to pick individual stocks or predict market trends. This simplicity makes them accessible to beginners and seasoned investors alike. So, index funds offer broad market exposure and lower fees, but are there any downsides? Well, just like any investment, index funds come with their own set of risks and potential drawbacks, which we'll explore in the next scene. Stay tuned. While index funds have many benefits, they also have some drawbacks. Let's start with the biggest elephant in the room. Index funds are designed to replicate the performance of a specific market index. This means they're not built to outperform the market, but to match it. If the market does well, so does your investment. But if the market dips, your investment goes down too. In other words, the upside of an index fund is limited to the performance of the market it tracks. There's also a lack of control that comes with investing in index funds. You're essentially putting your money into a predetermined basket of stocks or bonds, without any say in which specific companies or sectors you're investing in. If you're someone who likes to have a hands-on approach to investing, this might not sit well with you. Another potential downside of index funds is their inability to react quickly to market changes. Now, this is where the passive nature of index funds could be seen as a disadvantage. Unlike actively managed funds where fund managers can respond to market changes by adjusting the portfolio, index funds remain static. They continue to mirror the chosen index regardless of market conditions. This could lead to underperformance during volatile markets where active management might outperform. Finally, it's important to remember that not all index funds are created equal. Some have higher fees and expenses than others, which can eat into your returns over time. While it's true that index funds generally have lower fees than actively managed funds, it's still crucial to pay attention to the expense ratio when choosing an index fund to invest in. So, like any investment, index funds come with their own set of benefits and drawbacks. It's about understanding these limitations and deciding if they align with your investment goals and risk tolerance. Don't forget, investing is not a one-size-fits-all strategy. What works for one investor might not necessarily work for another. Always make sure to do your due diligence before making any investment decisions. Let's summarize what we've learned about index funds. Riding the wave of the financial world, index funds have emerged as a popular investment vehicle for many. They are a type of mutual fund or exchange-traded fund that holds a mission to replicate the performance of a specific market index, like the S&P 500. This essentially means they're aiming to mimic the movement and returns of these market indices, giving investors a slice of the wider market in one neat package. When you invest in an index fund, you're not putting all your eggs in one basket. Instead, you're spreading them across a diversified portfolio that mirrors the chosen index. This broad market exposure can be a boon for those who prefer a more hands-off, passive investment strategy. And speaking of passive, that's one of the key characteristics of index funds. Unlike actively managed funds, where fund managers are constantly buying and selling individual stocks, index funds simply follow their chosen index. This follow-the-leader approach can result in lower fees, which is music to the ears of any investor. But as with all investment strategies, index funds are not without their potential downsides. This passive approach means you're at the mercy of the market. If the index goes down, so does your investment. And while the broad market exposure is a plus, it also means you won't see the potentially higher returns that can come from investing in individual high-performing stocks. In the end, index funds offer a way to invest in the broader market with less effort and often at a lower cost. But like any investment, they come with risks. It's a balance of potential reward and risk tolerance. So, that's a quick tour of how index funds work. Remember, it's always important to do your own research before making any investment decisions.